Hello friends. In our previous session on transaction in foreign exchange market, we have seen the concept of spot, forward, future and option market. Today, we are continuing the discussion on the same topic by looking at the concept of currency swap, the nature of foreign exchange risk, the concept of hedging and speculation, and also that of arbitrage. Welcome to the video. So these are our topics. We'll start with the currency swap. Then we'll examine the nature of foreign exchange risk. Then we will see the hedging, which is known as avoidance of foreign exchange risk. Then we'll examine the speculation, which is known as acceptance of foreign exchange risk. And we will end with two concepts of arbitrage, namely currency as well as interest arbitrage. Let us begin this session by looking at the nature of currency swap. Currency swap refers to the spot sale of a currency combined with the forward repurchase of the same currency as a part of a single transaction. That is, we have already seen that spot sale is an immediate contract, while future contract or a forward contract is an agreement between two parties to exchange currencies in future. In swap contract, it is a set of spot as well as forward exchanges packaged into one contract. That's why we define it as a spot sale of a currency combined with the forward repurchase of the same currency as a part of a single transaction. So in currency swap, principal amounts are exchanged at both beginning as well as at the end of the currency swap. Now let us analyze the pattern of currency swap with an example. Let us suppose that the State Bank of India do have, say, dollars with them. Maybe it requires dollars only after 3 months, but they have plenty of dollars with them. Maybe after 3 months, it requires dollar. At present, SBI wants to have more of pound sterling. No, SBI can enter into a situation in which it can make a spot sale of dollars with respect to, say, a foreign bank, maybe a bank based on UK, which is HSBC UK, for example. It can make a spot sale of dollars to HSBC and can in return of pound. And after 3 months, it can make a forward repurchase as well. So it have two contracts or two transactions. That is a spot as well as a forward transaction. So rather than these separate two transactions, if these two transactions combined into one contract, we have the characteristic or a feature of the swap contract. That is, instead of a spot and forward transaction, if we can combine these two and have a single contract, we have the example of swap contract, which is the spot sale of a currency combined with the forward repurchase of the same currency as a part of a single transaction. That is, now SBI need not have to sell dollars at spot and repurchase dollars with a forward contract. Instead, it can enter into a swap contract in which there is a spot sale of dollar as well as forward repurchase of dollar, which HSBC UK as a part of a single transaction, and we have the nature of the currency swap. That is, it's a spot sale of a currency combined with the forward repurchase of the same currency as a part of a single transaction. So there is a spot sale as well as a forward repurchase or a spot transaction along with a forward transaction. So we will have a spot trade as well as a forward trade, and the difference between this forward rate and spot rate is known as the swap rate. So swap rate is the difference between the spot rate as well as the forward rate in currency swap. Perhaps the first well-documented currency swap was involved with a currency swap agreement between World Bank and IBM, International Business Machine, in the year 1981. In that agreement, the World Bank committed itself to finance some of the IBM's German mark or Swiss franc debt. In return for the commitment by the IBM to finance some of the World Bank's dollar debt. That is, IBM agreed to finance the World Bank's dollar debt while the World Bank agreed to finance the debt of IBM, which was in German mark and Swiss franc. Since then, there has been enormous growth in the currency swap market. And swap markets are extensively used by major corporations, international financial institutions, and even governments, and are a very important part of the international bond market as well. The advantages of swap market compared to the other market, because it's two separate contracts into one contract, is that it involves lower transaction cost and there's a decrease in risk exposure, and the currency swaps are extensively used by the commercial banks for interbank trading involving purchase as well as sale of currencies in future delivery. Even though swap contract is like a forward contract, it's like a future contract since it involves a future exchange of currencies as well, there are some significant differences between the future or the forward contract and with respect to that of swap contract. And the most obvious difference is that while the forward and future contracts are of the much short duration, the forward contracts have, or the swap contract, in fact, the swap contract do have a long duration, because most of the swap contract covers a period of 5 to 20 years and sometimes even possibly longer. We have seen that in the case of forward contract, the maximum time period is up to 6 months. While as far as swap contract is concerned, it can be years, that means up to 5 to 20 years. And this factor is particularly important in explaining the popularity of swap contract in business. And with the swap contract, the parties will be able to obtain highly specific agreement with the time horizon and payment schedule matching close to their needs. Now shifting our focus from currency swap to foreign exchange risk. We know that under a flexible exchange rate system, the exchange rates are determined by the market forces of demand and supply. And through time, a country's demand and supply curves for the foreign exchange will obviously shift, causing the spot exchange rate to change very frequently. The country's demand and supply curves of foreign exchange over time can shift due to a number of factors. And in a dynamic as well as changing world, the exchange rate frequently change, reflecting constant changes of the numerous economic forces simultaneously at work. Then these frequent and large fluctuations in exchange rate imposes a risk to those participants, individuals, firms, organizations, who have to make or receive payments denominated in foreign currency in future. This is the concept of foreign exchange risk. That is, foreign exchange risk arises out of the fluctuations in the value of asset, liabilities, income or expenditure as a result of unanticipated changes in exchange rate. So whenever we have an open exchange rate, whenever we have a flexible exchange rate, then foreign exchange risk will obviously emerge. It's due to ever-changing spot exchange rate, and whenever our future payments, receipts, income, expenditure, asset, liabilities are denominated in foreign currency, we are subject to face a foreign exchange risk. So We also call it as a risk exposure because a person will be exposed to risk. If exchange risk, if the value of person's income, wealth, asset, liabilities changes when exchange rate changes unpredictably in future. So we have three kinds of risk exposure: the transaction exposure, the translation or accounting exposure, or economic exposure. Transaction exposure arises whenever our future business transaction involves foreign currency. That is, it arises when transaction involving future payments and receipts denominated in foreign currency. The translation and economic exposure mostly arises to the firms. And the translation or accounting exposure arises when firms try to value their inventories and assets held abroad in terms of domestic currency for the inclusion of its balance sheet. That is, when a firm tries to prepare balance sheet and will try to include the asset as well as its liabilities or even inventories which it held abroad, it obviously will want to convert these asset or inventories abroad into domestic currency. So foreign exchange risk or risk exposure, or what we call the translation or accounting exposure, arises when firm try to value inventories and asset held abroad in terms of domestic currency in order to incorporate them into firm's balance sheet. Economic exposure arises when firm try to estimate the domestic currency value of future profitability of the firm. So we have three kinds of risk exposure: the transaction exposure, the translation or accounting exposure, or economic exposure. And the translation as well as economic exposure arises most of the time for the firms. Translation exposure arises when firm try to prepare its balance sheet, and economic exposure arises when firm try to calculate the future profitability of the firm. Now, some people or economic agents will try to avoid this foreign exchange risk, while there are economic agents who will try to take advantage of foreign exchange risk. That's why we have two more concepts. When individuals, firms, economic agents tries to avoid the foreign exchange risk, it is known as hedging, while speculation refers to the acceptance of foreign exchange risk. We will begin with the concept of hedging. As we said, hedging is the avoidance of foreign exchange risk. Hedgers do not want to gamble on what exchange rate changes. They have acquired their exposure to foreign exchange risk due to their regular business activities, and they want to reduce, or they seek to reduce or eliminate the risk exposure by activity called hedging. So hedging is the act of reducing or eliminating the foreign exchange risk. How to eliminate this foreign exchange risk? And even though it can be done in spot market as well, most of the hedging takes place in the forward market. Now, how it can be done in the forward market? Now, for example, let us suppose that there is an Indian trader who wants to pay, say, $1,000 after 3 months. So the risk is that after 3 months, the spot rate may be different from what today. For example, say today, if the spot rate between dollars as well as rupee is, say, rupees 75 equals $1, maybe after 3 months, it might be rupees 80 equals $1. So there is a foreign exchange risk. So what this Indian importer can do, he can do an activity of hedging by entering into a forward contract. Maybe say forward contract is rupees 78 equals $1. So once he enter into a forward contract, the changes in the spot rate will obviously have no consequences to him. Because by now, he is very sure that the amount he needs is only rupees 78 equals $1 after say 3 months. So he can avoid the foreign exchange risk of ever changing the spot exchange rate. So, in the world of foreign exchange uncertainty, the ability of traders and investors to hedge greatly facilitates the international flow of trade as well as investment. Because without hedging, there would have been smaller international capital flows, less trade, and less specialization in production, and smaller benefit from international trade. So, hedging permits the exporters and importers to protect themselves against foreign exchange risk connected with the exchange rate fluctuation, and now they can more focus on their main activity, which is trade as well as finance. Now, from hedging, we are shifting our focus to the speculating. Speculation, as we said, is an opposite of hedging. Speculators accept foreign exchange risk. They accept or take risk in hope of making a profit out of unanticipated changes in exchange rate. So they expect a gain even though it is uncertain. So uncertain gain from an unanticipated changes in exchange rate. They commit oneself to the uncertain future exchange rate movement. So the speculators basically transact in the foreign exchange market because an uncertain as well as unanticipated changes in the exchange rate. If the speculators anticipate future changes in the spot rate in a correct way, they can make profit. Otherwise, they can incur loss as well. Thus, speculation means committing oneself to the foreign exchange risk or committing oneself to uncertain future value of exchange rate. Like hedging, speculators basically do their activity in the forward market as well. Speculators, while engaging in forward market, because they believe that the future spot rate corresponding to the date of the quoted forward exchange rate will be different. Following our example, let us say after 3 months the forward rate is say rupees 78 equals $1. What speculators anticipate that maybe after 3 months the spot rate will be different. When they believe that or when they anticipate that the spot rate is different, they will obviously do their activity of speculation because they will expect that if their anticipation is correct, they can make a profit out of it. If the speculators believe that the spot rate of a foreign currency will be higher in 3 months, maybe that after 3 months the spot rate is say $1 equals rupees 80. What they will do? That he can enter into a forward contract and after 3 months he can make a profit out of the dollar as well as rupee exchange rate. So he can enter into a forward contract and after 3 months, if his anticipation is correct, he can make a profit out of it. So if his speculator is correct, after 3 months he receives the delivery of foreign currency at a forward rate and he can immediately resell the amount at a higher spot rate and can realize a profit out of as well. So basically most of the speculation takes place in the forward market. Now there are two kinds of speculation. One is known as the stabilizing speculation, the other is known as destabilizing speculation. Stabilizing speculation refers to the purchase of a foreign currency when its price is falling or is low, with the expectation that it will soon rise. Or it refers to the sale of a foreign currency when the exchange rate rises, with the expectation that it will soon fall. That is, stabilizing speculation refers to a situation where speculators try to purchase a foreign currency when its price is falling or when exchange rate is falling, or they try to sell a currency when exchange rate rises or when its price rises. So obviously, stabilizing speculation moderates the fluctuations in exchange rate movement and performs a useful function, because they can, when the price is rising, they are trying to sell a currency. When its price is falling, they are trying to purchase a currency. So they can stabilize. That's why we call it as a stabilizing speculation. Stabilizing speculation moderates the fluctuations in exchange rate. On the other hand, destabilizing speculation, exactly the opposite. Destabilizing speculation refers to the sale of a foreign currency when exchange rate is falling, or it's a purchase of a foreign currency when exchange rate is rising. Obviously, they magnify exchange rate fluctuations. They increase the exchange rate fluctuation, or destabilizing fluctuation accentuate the fluctuations around of the exchange rate, or even above its long run value. So it can be proved very disruptive. It can obviously cause much disruption to the international flow of trade and investment. The issue is that when there is more of a destabilizing speculation, countries can caught into what is known as a vicious circle of depression and inflation that might be difficult to escape. So it's a very disruptive form of speculation, which is known as the destabilizing speculation. It accentuates fluctuation, it increases the fluctuation. So from speculation, we are shifting our focus to arbitrage. Simply speaking, the term arbitrage refers to a situation when economic agents tries to exploit the price differentials in two or more markets and try to make a profit out of the price differences. That is, it is a practice of taking advantage of price differences between two or more markets, and the profit being the difference between the market price at which the unit is traded. So that's the nature of arbitrage. Now we are examining two concepts of arbitrage, namely the currency arbitrage as well as interest arbitrage. We start from the currency arbitrage. It refers to the purchase of a currency in a monetary center where it is cheaper for immediate resale in another monetary center where it is expensive, in order to make a profit out of exchange rate differences. Now, if at all there is an exchange rate differences, through the process of currency arbitrage, the price will be driven up in the cheaper market and will be declining in the expensive market. So, as a result of currency arbitrage, the exchange rate between two currencies tends to be equalized in the two monetary centers. We know that at any given point of time, all the markets tends to generate the same exchange rate for a given currency, regardless of the geographical location. For example, if the rupee versus dollar exchange rate is, say, rupee 75 equals $1 in Kerala, it might be the same in New Delhi, it might be same in USA, it may be same in UK as well. That means irrespective of the geographical location, all the markets tends to generate the same exchange rate between two currencies. This uniqueness in the foreign exchange rate occurs because of the presence of arbitrage. Because whenever there is a differences between the exchange rate between two currencies, the arbitrageurs will act by purchasing currencies from a monetary center where it is cheaper for immediate resale in another monetary center where it is expensive, and they will make a profit out of it. Because there is always the presence of potential arbitrageurs in the market. Since this activity is taking place simultaneously, that is buying and selling currency take place simultaneously, there is no risk. And there is always a presence of potential arbitrageurs in the market who always will try to examine if at all there is a difference between exchange rate between two currencies in any of the market. And if they found if there is a difference, they will obviously undertake their activity of arbitrage and will take a profit out of it. And since this activity takes simultaneously, we also call it as arbitrage is a riskless activity for a guaranteed profit. Now, from the currency arbitrage, let us analyze the other arbitrage, which is known as the interest arbitrage. Interest arbitrage refers to the international flow of short-term liquid capital to earn higher returns abroad. That is, if there are differences in the interest rate, obviously, since international capital flow is responsive, is sensitive to the interest rate differentials, there will be the flow of short-term capital. And interest arbitrage refers to the international flow of short-term liquid capital to earn higher interest returns from abroad. It is the transfer of funds abroad to take advantage of higher interest rates in the foreign monetary centers. Now, interest arbitrage involves the foreign exchange risk because, let us have an example. Let us suppose that the rate of interest in UK as well as USA is different, and let us suppose that the return for set 3 months treasury bills is 10% in London market while it is 6% in New York. A US resident can exchange dollars for pounds in the current spot rate and can invest in the London because obviously it will provide a 4% more rate of interest. But there is an issue because if you want to invest in New York, he needs to convert his pound into dollar. Maybe after 3 months, when his return is available, he needs to convert dollars into pound. So there is a situation of foreign exchange risk when we do an activity of interest arbitrage. It involves conversion of currency at 2 points. That is, it involves conversion of domestic currency into foreign currency to make an investment first and a subsequent reconversion of the funds. And plus obviously the interest involved from the foreign currency to the domestic currency after maturity. So foreign exchange risk is obviously involved because there are two forms of conversion. First, from the domestic currency to the foreign currency, and after the return is available, from the foreign currency to the domestic currency. So we have two kinds of interest arbitrage. One is known as the covered interest arbitrage, and the other one is known as uncovered interest arbitrage. If this foreign exchange risk, which arises due to this conversion, if this foreign exchange risk is covered, we have what is known as the covered interest arbitrage. If it is not covered, if it is not insured, we have what is known as uncovered interest arbitrage. So under the covered interest arbitrage, it will involve a spot purchase of a foreign currency to make the investment at present, as well as a simultaneous forward repurchase of the currency. So it's have all the feature of a swap market. That means if a UK citizen wants to invest in USA, by saying that the rate of interest is higher in USA, he can enter into a swap contract, which involves a spot purchase of dollar as well as a forward selling of dollar. So we have a typical case of currency swap. So covered interest arbitrage basically takes place through a swap contract. So under covered arbitrage, a spot purchase of the foreign currency is initially made, followed with a swap contract of forward repurchase. If they do not want to insure against, or if they do want to have some kind of a speculation and are willing to accept the unanticipated changes in the exchange rate, it is known as the uncovered interest arbitrage, under which there is no forward or swap contract. Thus, we have seen the pattern of currency swap, which involves the spot sale of a currency combined with the forward repurchase of the same currency. We saw the foreign exchange risk. The avoidance of risk is called hedging. The acceptance of risk called speculation. We also saw the nature of currency arbitrage. Hope that this video is useful to you. You can always visit our blog www.skpeco.blogspot.in for additional learning resources. Until we meet next time, stay safe, happy learning. Thank you.